This is the most damning piece of data in the watch industry right now, and it isn't coming from Rolex. It isn't coming from collectors, from auction houses, or from the watch press. It is coming from insurance underwriters in London, New York, and Zurich. The premiums they are quietly setting on Submariners, reference 12661LN, GMT-Masters and Daytonas, have decided what Rolex itself has not yet publicly admitted. The most desirable sport watches in the world are becoming structurally uninsurable in the cities where they were once status symbols. And the brand cannot fix it. Insurance companies do not care about heritage. They do not care about the dial code, the bezel insert, the in-house movement, the caliber 3235 beating inside a current Submariner, or the caliber 4131 in the GMT-Master. They do not care that you waited 4 years on an authorized dealer list or paid above retail on the secondary market. They care about one thing, with absolute mercenary clarity: the probability that the object on your wrist will be violently removed from it. And right now, for Rolex sport models, that probability has gone vertical. The luxury watch market has spent 4 years convincing itself that the sport model boom was permanent. Premiums on the secondary market normalized. Gray market prices on platforms like Chrono24, where the watch chart's overall market index tracks real-time secondary pricing, ticked back toward retail. Authorized dealers stopped pretending Daytona allocations were impossible. The narrative settled into something comfortable, a correction, not a crisis. Insurance companies are not seeing a correction. They are seeing a structural shift in risk that has fundamentally broken how they price these specific watches. And in the last 18 months, accelerating sharply since the third quarter of 2023, the major luxury insurers, firms like Chubb, TH March, and Jewelers Mutual, have started doing things they have never done before in this category. They are raising premiums on individual references. They are writing geographic exclusions into policies. They are requiring proof-of-wearing protocols that would have been unthinkable in 2019. And in a small but growing number of cases, they are simply declining to insure certain Rolex sport models at all. To understand why, you have to understand what insurance companies actually look at when they price a watch. The premium on a luxury timepiece is built from 3 numbers. The replacement cost is what it would take to put another one on your wrist if yours was gone tomorrow. The recovery rate is the percentage of stolen watches in this specific reference that ever come back. And the theft frequency is how often watches in this category are taken in the first place. Multiply those together, add the insurer's overhead and margin, and you get a quote. For most luxury watches, those 3 numbers move slowly. Replacement costs track inflation. Recovery rates are stable because most stolen watches end up in the same handful of channels. Theft frequency creeps up or down a few percentage points a year. For Rolex sport models, every one of those numbers has gone vertical. Replacement cost is the cleanest part of the picture. A Submariner date, the 126610LN, that listed for around $8,500 in 2018, now sits north of $11,000 at retail and substantially more on the secondary market for desirable references. A ceramic Daytona, the 126500LN, has a replacement cost, assuming you can find one, that is multiples of its sticker price. From the insurer's perspective, every Submariner on every wrist in 2026 is now a much more expensive object to replace than the same watch was 5 years earlier. That's the easy part. The recovery rate is where the math starts getting ugly. Stolen luxury watches used to follow a relatively predictable path. They were pawned domestically, flagged in trade databases, and a small but meaningful percentage made their way back to insurers through routine police work. The Watch Register, the largest international database of stolen watches and run by Managing Director Katja Hills, recovers a steady stream every year. Industry estimates have historically pegged recovery rates for stolen Rolex sport models in the high single digits. Not great, but priceable. That number has collapsed. The reason is the same reason every other piece of the watch market has been disrupted in the last 3 years. The Chinese superclone factories. When a watch can be turned into a wearable, untraceable, visually identical copy from 3 feet away within 48 hours of being lifted off a wrist, the economics of theft change completely. Stolen Rolexes don't go to pawn shops anymore. They don't enter trade databases. They get melted, parted out, or shipped through channels that recovery firms simply cannot penetrate. The recovery rate insurers used to bake into their pricing models is, in practical terms, gone. And then there is the theft frequency itself. It is the part that has changed the most, the fastest, and the part that nobody at Rolex, no boutique manager, no authorized dealer wants to discuss publicly. In London, the Metropolitan Police now treats watch theft as a distinct organized crime category. Detective Sergeant Andy Swindells leads the dedicated unit targeting what have become known as the Rolex Rippers, and the unit's existence alone tells you how seriously the authorities are treating this. The per capita rate of luxury watch theft in central London has multiplied since 2019. Mayfair and Knightsbridge, the geographic heart of the British luxury market, have documented incidents of watch theft so frequent that some restaurants quietly advise diners to remove their watches before sitting outside. In New York, certain blocks of the Diamond District operate with a kind of unspoken protocol about which watches you wear into which buildings. In Milan, in Paris, in parts of Los Angeles, the pattern repeats. And the watches being targeted, overwhelmingly, are not Patek Philippe's, Audemars Piguet's, or Vacherons. They are Rolex sport models. The reason is brutally simple. Sport model Rolexes are the most liquid stolen watch category in the world. They are recognizable from across a street. They sit on millions of wrists, which means they don't draw attention until they are gone. They retain enough value in disassembled form that a stripped movement and case is still worth real money. And the universe of people willing to buy a no-questions-asked Submariner is orders of magnitude larger than the universe of people willing to buy a Patek 5711. Insurers know all of this, and they are pricing it in. What this looks like at the policy level depends on the insurer and the jurisdiction, but the patterns are becoming uniform. Premiums on individual schedules for Submariners, GMT-Masters, including the 12671, BLRO Pepsi, and Daytonas, have risen substantially in the last 3 years, well ahead of general inflation, well ahead of replacement cost increases, and well ahead of equivalent dress watch references like a Datejust or an Oyster Perpetual. Some insurers have introduced what amount to geographic surcharges, where the same watch costs noticeably more to insure if its owner lives in central London or central Manhattan than if they live in a suburb. A handful of policies now carry exclusions for theft that occurs while the watch is being worn outside specific safe zones, a clause that would have been laughable in the pre-pandemic market. And then there are the cases insurers are simply walking away from. Specific references, specific owners, specific cities, where the underwriting math no longer works at any price the customer would actually accept. Those policies aren't being marketed as discontinued. They are just quietly not being written. This is the part of the story that matters most, because it is the leading indicator everyone else in the watch market is missing. Insurance pricing is, in a real sense, the only fully honest data we have about a luxury watch's actual position in the world. Auction prices are manipulated. Dealer prices are negotiated. Brand pricing is controlled by Rolex itself. The secondary market, whether you are reading it through Chrono24 or watch charts, reflects whatever narrative is dominant that quarter. None of those numbers are pure signal, but insurance premiums are. They are set by people with no emotional attachment to the object, no reason to inflate or deflate its standing, and a direct financial incentive to be correct. When insurance premiums on Rolex sport models start rising faster than the watches themselves are appreciating, and they have, that is the market telling you something the watch press, even Hodinkee, has not yet caught up to. The risk profile of these specific references has changed permanently. The brand's most iconic, most desired, most culturally dominant products are now, in pure actuarial terms, the most expensive objects of their value class to own and protect. And the brand cannot fix this, because the brand did not cause it. The same scarcity, the same desirability, the same global recognizability that made these watches Grail tier is now the thing eating into their downstream economics. There is a quiet question this raises that nobody in the industry seems willing to ask out loud. If the all-in cost of owning a Submariner, including purchase, premium, and the ambient anxiety of wearing it, keeps rising faster than the watch itself, what happens to the next generation of buyers? What happens when a 35-year-old considering their first serious watch realizes that the smarter purchase, on every metric except brand prestige, might be a Grand Seiko, a Tudor, or a Lang? What happens when the watch you bought to wear becomes a watch you keep in a safe? Rolex has weathered every challenge thrown at it for 100 years. The quartz crisis, the brand management implosions of its competitors, the repeated death of mechanical watchmaking. It has adapted every time by being smarter and more disciplined than anyone expected. But the insurance industry is not a competitor. It is not a trend. It is not a cycle. It is the cold, unsentimental act of pricing reality. And right now, that pricing is telling us something Rolex itself has not figured out how to respond to. The most desirable watches in the world have become, by a measurable margin, the most dangerous ones to own. That is not a marketing problem. That is a structural one. And it is one of the very few stories in this industry where the people setting the prices have absolutely no reason to lie.